Entire thing. This entire session will be available on JMMB Group's YouTube channel. So feel free to hop over and take in anything you would have missed. My name is Carrie Ann Stimpson, and I'm the Group Chief Marketing Officer of JMMB Group. And it is my pleasure to support the navigation process through today's conversation. As you would have seen in the messages leading up, we are going to be talking about our 6-month performance to date. We would have disclosed our financials a couple of days ago. Today is Thursday. We would have done that on Tuesday. And as always, we love to come to you and share with you the background, additional details about what happened during the period, and of course, most importantly, to talk about the way forward. So it's going to be a very good, insightful conversation, and as always, once we finish our main presentation, we will open up the floor to questions from folks who are joining via Zoom. So as always, we look forward to engaging with you, and without further ado, allow me to introduce the two gentlemen here I'm being flanked with again today. To my right, this is our Group CFO, Patrick Ellis, and to my left, the gentleman who will be kicking off this morning's presentation, most importantly, is our Group CEO, Keith Duncan. So let's get started again. Now, Mr. Duncan, over to you, Sir Keith.
Good morning, everyone. Good morning to shareholders. Good morning to the media. Good morning to clients. Good morning to the team members at JMMB. And we're here for our investor briefing. And at the end of quarter two, reporting around 6 months financial update. And as usual, we want to be very open and very transparent with our shareholders, our clients, and the media as to where the JMMB Group is and the future that we see for the JMMB Group and the performance to date. And whether in good times or in challenging times, we are here to report and to keep everyone fully engaged and on board. And very clear around what our strategy is and how we are executing in ensuring that we deliver shareholder value or protect shareholder value. So, over the past 2 years or so, we have been in a tight monetary policy environment. Globally, central banks have been increasing interest rates significantly over the last 2 years. This is after coming out of the COVID environment where there was a very loose monetary policy where interest rates were reduced to almost 0%, both in the US by the Federal Reserve and the Central Bank in Jamaica, and very low levels in the Dominican Republic. Trinidad has held interest rates steady. However, inflation was thought to be very transient at the outset of after COVID, and that it would pass. However, what has happened is that inflation has become very, very sticky. And therefore, what has happened is that the central banks have had to move aggressively to bring down inflation as it impacts purchasing power. And inflation can be can cause volatility in markets, removes purchasing power, and impacts the most vulnerable. So inflation targeting has become the focus of central banks. And so therefore, we have seen in Jamaica interest rates moving from 0.5% to 7%. And interest rates have held there for a while. In the Fed, we saw interest rates moving from 0.25% to 5.25% to 5.5%, and the Federal Reserve has held interest rates steady for the last sitting. Now, the Federal Reserve really drives interest rates globally, because the domestic central banks like the Bank of Jamaica will set their rates because there has to be a interest rate differential between where the BOJ rate is at 7%, the signal rate, the policy rate, and where the Fed rate is at 5.25% to 5.5%. There has to be a differential, or you could see foreign exchange movement, and it could impact reserves. So therefore, one has to keep that differential so that investors and savers will keep their money in Jamaican dollars, as there is a reason and an incentive to do so. So therefore, the Federal Reserve has been driving what has been occurring globally with interest rates. And until the Fed begins to signals that interest rates could be reduced, what you'll find is that most countries will be looking to hold interest rates at the current levels. Now, the inflation reading that has been coming out is indicating that interest rates could be higher for longer. Most analysts had projected prior to in the last year or so that interest rates would begin coming off by even before now as we speak. Now the outlook is that interest rates could hold here and for a longer period of time, and therefore it impacts the business line of intermediation, right? So financial houses like JMMB make money through intermediation. You buy assets in the investment business line. You buy Government of Jamaica bonds. You buy emerging market bonds, and you also through your banking business line you book loans. Now interest rates move rapidly. For example, within a year, 18 months from Jamaica, from 0.5 to 7%. The Fed in the last year from almost 0 to 5.25 to 5.5%. That's rapid movement interest rates. Now, you book your investments and loans at yields that based on the market conditions at the time. So where financial houses would have been booking assets and buying assets would be at lower yields to where the market is right now. So for example, if you look at the average where GOJ globals are being issued. GOJ globals prior to the right around the pandemic was at the end of the pandemic was at about 5%, and they are now being issued at 6%, while the Fed has moved interest rates to 5.25% to 5.5%. Right, the Government of Jamaica and the Bank of Jamaica were in terms of on BOJ CDs have been issuing CDs to mop up liquidity or pull liquidity from the market to ensure that there is, there's less pressure on the exchange rate, have been issuing 30-day BOJ CDs at approximately 10.13% was the last issue of a BOJ 30-day CD. So what occurs here is that your assets, meaning your government paper and your loans, reprice much slower than your liabilities, your deposits, and your repos. So the cost of funds has moved faster than you are able to reprice the assets on your portfolio. So what does this impact? This impacts your net interest income business line, which is a core revenue line for all financial houses, right? And therefore, the spreads begin to narrow. So therefore, our Jamaica dollar cost of funds would have moved by about 400 basis points in the last year or so, but your yield on your assets only moved by about 100 basis points, or 100 to 250 basis points, right? While on the U.S. side, your cost of funds move in tandem with the Fed, and it moves significantly upwards, while the yield on your portfolios, including your Government of Jamaica paper, your yield on your asset has not moved as quickly as your cost of funding. So your net interest margin gets compressed and eroded, and therefore, as a net interest income line, it impacts your bottom line. And this is where JMMB and other financial houses would have been ensuring that we are able to manage that, and it has worked well for us in terms of our strategy to keep our profits at a credible level due to our diversification that JMMB has been employing over the last 10, 15 years through moving into banking and moving into other business lines, for example, real estate, insurance, etc., and money and remittances. So therefore, we get diversification by business lines. So when your investment business line is impacted, you earn from other business lines. Also geographical diversification, because the Dominican Republic and Trinidad and Tobago would be performing at credible levels, and therefore we get diversification through business lines and we get diversification through regional or regional footprint, right? Now, if JMMB 10 years ago, where JMMB was primarily a investment house, we would have been significantly impacted because the investment business line that's impacted significantly by these interest rates movements. And therefore, the diversification has really played out well for JMMB Group, and therefore we're able to deliver credible results for the year for this first 6 months of the year of $1.9 billion, right? If you look at our NII would have taken a hit year over year, moving from falling by $1.54 billion. So while we continue to grow our loan portfolio and our asset portfolio, our NII, net interest income, actually fell 27%. This is due to the compressed margins. Also, when you look at our gain on securities traded, in an accommodative market environment that we had even up to even 6 months post-COVID, there we could be actively trading securities, equities, because the stock market was doing fairly well, and bonds because there was more liquidity in the market, and we were able to extract good gains on securities traded from that business line. That has practically disappeared outside of the Dominican Republic, where we saw gains because the central bank in the Dominican Republic actually moved to reduce interest rates from about June through August. They have held interest rates steady since then. So therefore, based on the loosening of monetary policy in the DR, the Dominican Republic team was able to take gains on securities traded, and we have been able to move interest rate, governmental security, gain on securities traded upwards up to $3.3 billion for the year. So that demonstrates that if we're in an interest rate environment where interest rates are beginning to reduce, it means that we can look to more trade actively and there's more liquidity, and we can return to taking gains on our portfolios. The good thing about what we're seeing right now is that, and the data changes month over month, day over day. And what we're seeing was that the U.S. inflation data came in very positive yesterday, and also all the readings are showing that the Fed may not look to increase interest rates again, and there may be a bias to reducing interest rates. So, but the data comes in on a daily basis almost, and the market changes its sentiment based on the data that it sees, right? So, however, we are very happy that we are able to announce, with all of this in this challenging environment, credible $1.95 billion profit for the first 6 months of the financial year under these challenging market environments. And we do have strategies which we'll speak to later about how we move in terms of rebalancing our portfolios and looking to be able to reposition JMMB in the various business lines to get to the levels of profitability that we have seen in the past. But this is a challenging environment, and we are working through it, and we're protecting the value of our shareholders.
Thank you very much, Keith. Always appreciate our group CEO kicking off.
You know what, but I wanted to make one more point.
Sure, go right ahead.
One more point.
Go right ahead.
So while we were, our portfolios, and we have compressed margins on our portfolios, we were paying asset taxes on these portfolios, right? Oh. So the government of Jamaica is not, are these asset taxes based on the assets, not on the profitability of the underlying asset, right? So therefore, whether or not you make these are earning assets that are giving you the returns that you would want to see on a risk-adjusted basis, you have to pay this asset tax to the government. So therefore, over $1 billion of asset tax has been paid in Q1, $1.3 billion to the government of Jamaica. When you look at that against the dividends that we have paid to our shareholders, we paid dividends in early November of over close to $500 million, approximately $500 million, but paid $1 billion of asset tax to the government. Now, that asset tax, the government had committed from 2016 and in 2019 that they would begin to reduce. They actually went through the process of beginning to reduce in their budget the asset tax from 0.25% to 0.125%. It was in the budget. The financial sector got together and we said, it is COVID, it was a 2020 budget. Let us give our government and the people of Jamaica as much support as we can to support the vulnerable in this COVID period. And we said no, and we returned the asset tax to the government. We said, take it back, let us work through this COVID period, and then when things normalize, we can begin to now resume the path of reducing this asset tax, right, which is inflicted on the financial institutions. We are hoping now that the government of Jamaica, because this actually is a tax that goes to the government, and then it reduces our capital, it reduces our ability to pay dividends to shareholders, and therefore, we're talking about pension funds, we're talking about individual shareholders that are not able to receive their dividends, because in this challenging environment, we're still paying this asset tax. That could have gone to capital or to shareholders in dividend distribution.
Very important point to raise, Keith, and it's certainly very important to know. But thank you so much, Keith, for setting the context. As always, we like to have you as our group CEO, kicking off our briefing, setting a very important context and summary for us to move forward to the next segment of our main presentation here today. And as always, we have our group CFO, I call him the man with the numbers, to come and give us a more detailed breakdown about the financial performance for the period under review. So I'm going to hand over to Mr. Patrick Ellis, who will take us through those numbers and the outcomes of those. Thank you.
Thank you, Kerry, and thank you, Keith. I think you did an excellent job in setting the context of the macro environment, in the high interest rate environment that we're currently operating. I think you did an excellent job in outlining the increase in terms of interest rates and what that has done to our cost of funds in terms of the liability side of our balance sheet increasing at a much faster pace than the asset side, and as a result, the impact that it would have had on our net interest income. But showing the overall context, just to note that we posted net earnings, year-to-date net earnings of 1.92 billion. We would have seen that based on the earlier discussions of net interest income of 4.2 billion, down by 27% from 5.7 billion in the prior period. The gains on securities trading was 3.3 billion, and this number was a positive number for us. But as a result of our regional diversification, I think Keith mentioned in the Dominican Republic, where there was the central bank had moved to reducing interest rates, doing two cuts during the financial year so far, and we were able to generate over 700 million in gains from the DR. Our operating profit, as you can imagine, would have reduced, because if your overall revenue is down, your operating profit will be down to 740 million. But it shows a diversification where in Trinidad we had a more accommodative stand in terms of interest rates, and Trinidad would have generated a significant amount, over 50% of those operating profit. They are contributing in a positive manner, and I think we would have highlighted, and you would have seen in our results, whereby our investment business line, where it's mainly our trading book, would have been impacted based on the high interest rates, and we would not have been able, our interest margin as well, that would have been down. So overall, when you look at our net earnings from a regional standpoint, the regional diversification continues to work. 1.92 billion for us is a very strong and credible number. We continue to build in terms of diversification of our revenue streams, because if your core, your NII and your gains and securities trading are impacted, and that accounts for over 60% of our overall revenue. So if 60% of your revenue is impacted by the macro environment, what we have strived to do is not only diversify regionally, but also on a business line perspective. And we would have spoken in previous investor briefing about our smart growth, our FX contributing 1.3 billion, our off-balance sheet funds contribute $1 million in revenue, and cap markets, which would have been impacted also by this environment, contributing nearly 448 million. So overall, when you look at our other revenue stream as a percent of total revenue was approximately 36%. And this over the medium to long term, we're looking to move that into the 50% range. And that would be a good target for us. Our group CEO likes to say that those are revenue streams that you can put your pot on fire for. And it is part of our strategy in terms of over the medium to long term to grow those revenue streams and put us on a more sustainable path. On our expense side, you would have seen some growth in our expenses. Our efficiency ratio would have deteriorated. And our efficiency ratio is a percentage of your expense to your revenue. We're not where we want to be. As we would have mentioned, the liability side of our balance sheet would have moved faster. We are in the process of a number of initiatives. You would have seen our digitization projects, our standardization projects, our financial reporting projects that we have embarked on. These projects are supposed to generate efficiency so we can get scale in terms of growth. As I said, we're not where we want to be, but I think we have come a far way, and over the long term, we are going to reap benefits, significant benefits in my view from these initiatives. Just giving our stakeholders a view in terms of our diversification strategy. Sagicor Financial Company, SFC, continues to be an excellent investment for us. Our stake through various buybacks is now stand at 23.4%. The earnings we generated was 1.6 billion. Just to give some context in terms of SFC numbers for this financial year, the entire insurance industry would have adopted IFRS 17, and what that has resulted in a number of the industry's financials being restated for the adoption of this new accounting policy, and therefore their results would have been impacted somewhat. In terms of the Q2, they would have looked at their actuarial liability assumptions in line of current market conditions, coming out of COVID, looking at the mortality rates, looking at their overall product portfolio, and aligning those economics with the current environment. So they would have had an adjustment on the actuarial liability side. Coupled with the adoption of the IFRS 17, it would have impacted their results. But overall, the company is extremely strong. They recently closed, which is public information, the acquisition of an insurance company in Canada, Ivari. It's closed the 1st of October. And what that acquisition actually cost 350 million, which was at a bargain discount. And so we are expecting a highly accretive, positive result, both in terms of book value and earnings per share over the short to medium term. So we expect to get positive results from the acquisition of Ivari. Their historical results actually highlighted that over a 5-year period, they would have distributed over $1 billion in dividends, and that's $1 billion Canadian in dividends over a 5-year period. So it's an entity, something that we are pretty excited about. we would have seen Sagicor, they have paid 8 quarters in terms of consistent dividends, and we would have received 967 million in terms of year to date and 1.6 billion in terms of earnings. Just re-emphasizing also in terms of our business line diversification. This is our regional diversification. It continues to prove excellent results for the group. Jamaica still continue to be the dominant, 56% or 6.5 billion. But while our investment business line would have been impacted negatively in Jamaica, what we saw is that Trinidad contributed 3.3 billion, or 28% of our revenue, up from 22%, a 22% increase over the prior period. DR contributing 16% or 1.9 billion, and we are seeing a more accommodative stance in DR. So it continues to show that a regional diversification strategy continues to work for the JMMB Group. Keith would have mentioned the high interest rate environment and the impact that would have had on our investment business lines, which is mainly dominated by our GOJ securities, our global bonds, our emerging market bonds. And with the compression in spreads and the high interest rates in terms of your cost of funds, our investment business line would have been impacted negatively. However, we have seen a growth in our banking business line, and we had 6.9 billion in revenues on the banking business line, accounting for 59%, 8% growth year over year on the banking side. So while the investment business line would have been impacted, our banking business line continues to show positive growth. On the capital side of our business, our capital at the end of Q2 stood at 51.7 billion, demonstrating that JMMB Group is on a solid footing. Total assets of 688.1 billion, 4% growth. And it's not just growth stakeholders, but growth in the areas that we want to push. On the banking side, we have seen a 12% growth on our loan portfolio, growing to 200 billion. On the investment portfolio side, that would have been stable given the current market environment. We would have seen the growth on our deposit side of 6% of 182 billion, and on the repo side in terms of the cost of funds. On the capital on our balance sheet, as I mentioned, now standing at 51.752 billion, mainly driven by the growth in our profitability. And that is the backbone and the footing in which we look to execute our initiatives. In terms of our capital base, and the JMMB Group is a highly regulated group, and I'm pleased to report that all our regulated entities are above their capital requirements, and in most cases, as you can see in the slide that we're presenting here, has exceeded their capital adequacy requirement set by our regulators. With that, Kerry, I'll just turn over to you.
Thank you, Patrick. Thank you very much. As always, it's very, very important that we provide that kind of detail in terms of the analysis of the numbers of what would have been shared. So we appreciate you, as always, Patrick, for sharing that with us. And yes, we continue to understand the context of the environment. And in spite of everything that's going on, we do agree, yes, we have been delivering credible results, and we continue to make strides. And speaking of strides, we're moving into the last segment of this morning's presentation. And I'm not going to preempt him too much, but I'm going to hand it back over to my group CEO, who has some wonderful news to share, as well as taking us through the way forward.
Thank you very much, Carrie Ann, and thank you, Patrick. So, we have to give you an outlook, and we have to give you some context as to the way forward, the adjustments that we'll be making in our strategies, and tactical and more medium to long term in terms of strategies going forward. And we have painted a picture of the environment that we are in, that the whole globe is in, right? And Jamaica is not to be singled out, or the DR or Trinidad. It's just a global phenomenon with this inflation targeting that's occurring. And it does impact the financial services business globally. And we are not special in that regard. So, but we continue to strive, as Kerry, to make strides going forward. We have our strategy in place, and we continue to execute on our strategy, while protecting our capital and ensuring that we are delivering returns to our shareholders. We continue to look to increase shareholder value. And we're continuing our expansion into new territories. And we would have announced that we are now licensed to operate as a securities company dealer in Barbados through JMMB International Limited. And as of October 12th, we're up and running in Barbados, and we are very happy about this, because it's we're able now to consolidate across the region: Barbados, Trinidad, the Dominican Republic, and Barbados is a hub, being a financial center within the Caribbean region. So we're happy to be in the Bayesian market, and we're looking forward to growth in that market, and acquiring some market share in Barbados. And we have been able to do so in the past in Trinidad through JMMB Investments in Trinidad. We have been able to take market share and doing quite well in JMMB Investments in Trinidad, and also through our Puesta de Bolsa in the Dominican Republic, which is one of the leading Puesta de Bolsas, or securities dealers, in the Dominican Republic. So we are now inserting ourselves in the Bayesian market, and we look forward to driving results. We have actually Michael Jordan online, who is who leads the operations in Barbados, and if there are any questions, he's online. So we're looking to delivering the solutions that JMMB have become accustomed to delivering in these markets, and as we expand our suite of products and services through our integrated financial services model, this is where we'll be rolling out in Barbados. We continue to explore opportunities in Central America. We do have a robust pipeline, because we're always evaluating opportunities for mergers and acquisitions, and we do have a robust pipeline, and we do have business development opportunities or acquisition opportunities in our pipeline. So we spoke about the interest rate environment and the fact that the interest rates will remain higher for longer. So therefore, we have to make our own adjustments in how we do business. The market would have anticipated that interest rates probably would have started coming off beforehand, but therefore, in the what is now projected is that interest rates will remain higher for longer, and therefore we are going to speak a little bit about the adjustments that we're going to make in optimizing our balance sheet going forward. So we have to do some rebalancing of the balance sheet, because especially in Jamaica and the Dominican Republic, where we would have acquired lower yielding assets, the government of Jamaica was issuing bonds at 5% and now at 6%. In terms of globals, that's where GOJ globals are trading, and in the Dominican Republic also. So we're going to have to look to migrate into higher yielding assets from lower yielding assets to, and this may mean us taking on, looking to reduce the portfolio, move into cash, and look to take on higher yielding assets to boost the yield on our portfolios. And that is one on the securities, on the investment business side. And on the bank side, we will have to continue to price our loans in relationship to where the market is operating. We're going to have to actively manage our cost of funds also by optimizing our funding mix, by moving to open more transactional accounts that in terms of for corporates and for retails, that that funds moving in and out of the accounts, but these attract lower yields than or lower rates than you would have on your certificates of deposits and your repos, etc., etc. So therefore, it's optimizing your funding mix and bringing down your cost of funds so that you can restore and move your net interest income back into increasing the numbers through net interest income. So it's our intention to reposition our portfolio. Management has been actively looking at this, and we will be executing strategies over the next 4 months or so, looking to reposition our portfolios and reposition the flow of funds and across business lines and capital over the next 4 months, as I said before. So one of the areas that we must look at is our product suite, right? And therefore, when we look at the repo business line, what we're seeing is that the risk-adjusted returns on repos is not where we should be allocating as capital. The net interest, what we earn on the banking business line and the spreads we earn on the banking business lines would suggest that we should be moved more to banking at this point in time, because the risk-adjusted returns through growing the loan portfolio would be significantly higher than on the investment portfolio, and we'll be looking to make that adjustment. And this is where diversification comes in. And as Patrick had pointed out, we see the banking business line growing because it's a deliberate effort that we're making as a group to move to grow the banking business line for further diversification. So the investment business line, which used to contribute 50, 60, 70% of our revenues before, we are now diversifying and growing the banking business line and other business lines, right? So the other business lines that we're talking about would be, for example, our money transfer business line. We have been able to take significant market share over the last 5 years. We want to put some emphasis there. Our insurance brokerage business line has been performing has shown some real promise, and we're looking to put some effort in that area. In the payments area and other areas where we're looking to move capital, and one of the things is that when you are growing portfolios, whether it's an investment portfolio or banking portfolio, you have to allocate significant capital to these business lines. There are other business lines like off-balance sheet business lines that JMMB fund managers and or other fund managers, or SAFI in the Dominican Republic, or unit trust in Trinidad, that will be allocating more effort to growing that business line, because it does not absorb the level of capital as if you grow balance sheets by using your capital, growing your balance sheet. So we grow off balance sheet. We'll be issuing new products also in relationship to client, such because we are quite aware that clients don't like the volatility of returns, and in terms of their off-balance sheet exposure and the unit trust, etc. So we'll be looking to issue products that are stable net in terms of returns, and we call them net asset value, that the value of the funds don't move in a significant way. We were also looking to other business lines, strategic business lines, novel and innovative ways to access credit, and you'll hear about that in time to come, right? And therefore, what we're looking to do is to diversify, greater movement into banking, greater movement into other business lines, as I discussed earlier, and growing non-interest income earning as a strategic push, such that we're offering value-added services which are fee-based but value-added, such that our clients feel good about the value that's being delivered and are comfortable that in paying the fees as we now have, because JMMB's fee policy is that value-added, cost recovery, and also no nuisance fees. So therefore, we are looking at that to ensure that we are delivering value-added services to our clients that we can earn fees from. Patrick has spoken to Sagicor Finance, and that turned out to be a wonderful investment for the JMMB Group, as it also is almost another diversification play, because in a high interest rate environment, insurance companies actually perform better. We'd have seen that in the Sagicor Jamaica results, where they delivered really positive results in this environment, because the insurance environment greater thrives in a high interest rate environment. And therefore, Sagicor Finance has turned out to be almost like a hedge for us in providing solid earnings in this period where the investment and the banking business lines would have seen margins being compressed. With the acquisition of Ivari, they have seen their credit rating increase by S&P and Fitch, and now Sagicor Finance is now an investment grade company group, and therefore they'll be able to access capital at cheaper levels and funding at cheaper levels, and therefore we would see that this will augur well for the future of the earnings of SFC. Also with the acquisition of Ivari, they are now in both the Sagicor USA and Ivari in Canada. It gives opportunities for consolidation in North America of both operations. So Sagicor is, we're very happy with where that's going. They're seeing some volatility in their returns due to the IFRS 17, but we think this is a transient year, and by next year the earnings should settle down, moving from highs to lows, but more settle down to delivering core returns. Going forward, what we know is that within the Jamaica market, the government of Jamaica is no longer crowding out the private sector, because Jamaica is on a sustainable path of reducing its debt, looking to get our debt levels down from the government of Jamaica down to 60% of GDP in the year 2027-28. So this opens opportunities for the growth of private credit, and this is where JMMB is positioning itself to grow our banking business line through loans, to grow our capital markets area through issuances of corporate commercial paper, corporate paper, equities, and JMMB has a strong footprint in the capital markets area. It's a little tough in a very restrictive monetary environment, but we are well positioned to take advantage of the growth of private credit, and which will contribute significantly to the growth of the Jamaican economy. So as I said before, our smart growth strategy is around positioning JMMB for where we see the market growing, and the market is growing in private credit, banking, off balance sheet, and we're looking to fee-based businesses like money transfer, insurance, and those areas. The real estate business line we're in the early stages of development, but we have some good projects on the ground under development, and within the next 2 years or so we should start seeing some real positive returns from the real estate business line, along with private equity, which we have been making some recent acquisitions of Quorum and Island Car Rental. So we're moving in the right direction. Diversification is at play and is working for us. And we continue with the M&A opportunities I spoke to earlier, and we will continue to increase value to our shareholders. Tough environment, but we are not phased. We will make the adjustment that we need to make as a management team and board, and we will look to continue to increase shareholder value. And we can't do that without our people, and we have to continue to invest in our people, because our people at JMMB that allow us to deliver great value to our clients and to our shareholders. So on that note, I want to thank everyone for coming out this morning and listening in, and I hope we're able to provide great context as to where we are. Thank you very much. Over to you, Kerry.
All right. Thank you very much, Keith. So yes, really, really excited. So JMMB, we are now officially open. We have our operations live in the beautiful, well, all islands are beautiful, right? All of the Caribbean island nations are beautiful, but very happy to be a part now on the ground in Barbados. So now we can officially say we're not just Jamaica, Trinidad and Tobago, and the Dominican Republic. We are Jamaica, Trinidad and Tobago, the Dominican Republic, and Barbados. So we look forward to that and very excited about that development and for all the things to come. And again, we really, really appreciate the continued partnership with our investors, with our clients, and of course supported by our wonderful team at JMMB right across the group, right across the region. So we are now ready to take questions. I know on our Zoom call we have a number of guests, certainly members of the media and the broker analyst community, who have already begun to submit their questions. So we're going to go right now to our Q&A section. And our very first question, coming right out the gate as usual. Good to see you online, David Rose of the Jamaica Observer, and also noted well-known analyst, right, David? David knows his numbers as well and keeps us on our toes. So good morning, David. Thanks for joining. David's question is, how much has been injected by JMMB Financial Holdings into JMMB Bank Jamaica since March 2023? Also, where are you on the Basel III timeline for Q4 2024 of this current JMMB financial year? And I'm going to ask Patrick Ellis to take the answer to that question.
Thanks, Kerry. Well, in terms on the capital side from the financial holding company, we have injected 1.3 billion into the bank. Currently, our capital adequacy ratio stands at approximately 17%. In terms of the Basel III initiative, as you know, that's an industry initiative. We continue to work through with the regulators, providing the feedback. We are running the respective scenarios, and by the end of the financial year, I would say we should be on track there or thereabouts.
All right. Thank you very, very much, Patrick. And thanks again for your question, David. I'm going to hop over now to a question from someone else who has also joined us online and someone who always continues to participate in these briefings. Al Edwards. Hi, Al. How are you? Thanks for joining as always. And Al has a question coming, I guess, certainly, Keith, off of the point you would have raised about the asset tax. And Al's question is, who is lobbying to address the asset tax situation? It appears operations like JMMB need a little help here given the present environment. And I'm going to invite Keith, who is happy to answer that question.
Thank you very much. And thank you, Al, for the question. No, so therefore, the financial institutions that are impacted will be the Insurance Association of Jamaica Insurance Companies, the banks, and the security dealers. Now, in 2020, we all signed off and we said to the Minister of Finance and the government of Jamaica, we will not draw down on your budgetary allocation to reduce the asset tax, right? And we wrote to the Minister explaining, because we understood the context wherein there was a lot of uncertainty around COVID, and we as responsible corporate citizens thought that was the right thing to do. We now believe that we're in this environment, and the Jamaica Security Dealers Association and the Jamaica Bankers Association and the Insurance Association of Jamaica have written to the Minister of Finance, speaking to beginning to get back onto the path of reducing the asset tax or removing the asset tax, right? Because as I said before, it really impacts our capital, and it impacts of the industry, and it impacts also the ability to pay dividends to shareholders, pension funds, to individual shareholders, to institutional shareholders who have acquired shares in companies so that they can get their dividend return, plus capital growth, plus their growth in their shareholder value. And therefore, it is a distortionary tax, as acknowledged by the Minister of Finance and the government of Jamaica. And it was supposed to be temporary between 2013 and 2016, but it has remained in place. And the financial institutions already pay a 33% tax, right? And then to have this as an additional tax, yes.
The IMF had indicated it should have been removed as well.
Yes, and this was a part of the IMF agreement that was temporary, as Jamaica needed to, at the time between 2013 and 16, needed the additional revenues. Now, Jamaica has doing quite well right now in terms of we have bounced back from COVID. Our revenues are soaring. We're able to pay out healthy, packages to our public sector in the main, and we believe it's time now that the government of Jamaica look at resuming the reduction of or removal of the asset tax. So the Jamaica Security Dealers Association, the Jamaica Bankers Association, and the Insurance Association of Jamaica now need to get this into the public domain, because this impacts not only the financial houses, but it impacts the shareholders of financial houses. And this is the average shareholder, individual shareholders, pension funds, etc.
Thank you very much, Keith. So thanks again for that question, Al. And, I just wanted to follow up, Keith, because Al actually had a question, not so much related to the asset tax, but I think since you're on the floor, he wanted to know why Barbados as opposed to Costa Rica.
Well, Al, we have, Central America has always been in our sights. And has always been a part of our strategy. The Dominican Republic was supposed to be our entry point, and then we look to leap over into Central America. And we have always been evaluating opportunities in Central America, and continue to evaluate opportunities, and continue to push in that regard in Central America. Barbados, because Barbados is an evolving market. We have been in Barbados before when we had Caribbean Money Market Brokers, when Caribbean Money Market Brokers was a subsidiary of JMMB. We are now looking to return to that market. It only makes sense for us because we're right there in Trinidad, and we're right there in Dominican Republic. And the Barbados is, we can leverage our Trinidad business line and in terms of being able to get the efficiencies between Trinidad and Barbados, and without having to put any significant resources. So therefore, we can look to get market share in Barbados. We think it's a critical market. There are good things happening in Barbados, and we believe the Barbados market will open up. They're taking down their debt levels, as we see. They have an IMF agreement, and so they have some level of macroeconomic stability. So we think it's a good time to be in the Bayesian market, positioning for future growth in that market.
Thank you very much. Thanks as always for your questions, Al. And I'm just going to hop back over to a question from David Rose, and I'm just going to take part of the question, David, and I'll tell you why. So the question, which we're going to invite Patrick to answer, is JMMB Investments had to refinance a ton. Thanks for that, David. David says a ton of debt last financial year, which saw interest expense jump by double digits. He's therefore asking, how are you repricing your financial assets to grow the spread? There's a part B to your question, David, and we're going to hold back from responding on that. You're asking, will JMMB GL refinance its four pref shares in January? We're not in a position to speak to that just yet for regulatory reasons, but stay tuned. You will definitely hear about that in short order. But I'm just going to give that first part of the question over to Patrick about how we're repricing our financial assets to grow the spread.
Right. So good question, David. So I think we would have spoke to the fact that, just putting it in context, so on the liability side of your balance sheet would have repriced faster than the asset side. I think Keith mentioned in terms of where we are on the asset side, we're looking in terms of the portfolio mix, higher yielding assets. In addition to that, I think on the repo book, you would have noted on our balance sheet that was flat. I think going forward, you will see some reduction on the repo side of the business, because what we're going to be doing is putting capital into other business line. I mentioned our other revenue streams, where over the medium to long term, we want to move that to about 50%. We're looking to transition some of those projects into banking, where the returns are just as favorable. And then from a earnings perspective, the spread is not impacted, but also it frees up capital in the investment business line, where we can redeploy those capitals. So you will see some contraction on the investment business line, and you will continue to see growth in terms of the banking side of the business, and also into our other revenue stream and business line, where it doesn't take up that capital. We free up that capital for other purposes.
Okay, thank you very much. Alrighty. Okay, so we were getting the questions fast and furious here. And I'm going to take another question here from David Rose again. And we're going to invite Gifford to respond. I'm going to introduce Gifford shortly, but let me first read the question from David. And the question is, you mentioned the potential introduction of business debit cards and the mobile app. I understand that you can't give a specific timeline because of regulatory reasons, but is it that business credit cards would come alongside the personal credit cards? Thanks for your question again, David, and I'm going to invite our General Manager for Digital Services, Gifford Rankin, who is online ready to answer. Gifford, would you take the mic for us, please, and respond? Okay. Gifford?
Hi, Kerry. Morning.
Morning.
Can you hear me? Morning. Thanks for that question, David. Yes, we are currently working on our credit card offerings for both business and personal. So the answer to your question is yes, that they will come together.
Okay, so they would come together. Thank you very, very much. Much appreciated. Thanks again. Okay, so I'm just going through as many questions as we can. I think we have time for at most 2 more questions. And sorry, folks, I'm here just making sure I navigate and make sure we line up the respondees, responders to the right question, because we want to make sure we have the right subject matter expert responding to the specific question. Now, there is a question here from David about which DOMREP subsidiary does $77.93 million dividend payment for the NCI relate to. David says he's trying to understand the capital outflow.
That's what I can lead more investor briefing.
We probably need to have, put David right beside us here.
Right.
So would be Patrick or Patrick? Yes.
So that would be our subsidiary in the DR, the Puesta de Bolsa. We are 80% shareholder, so the minority of 20% would fall to the minority. That's the investment business line in Dominican Republic. So in the upstream of dividends into the holding company, 80% would be ours and 20% goes into the minority.
Okay, thank you very much. And our final question, which is again from David, and then we will, I think we can wrap it, because what's happening, we're trying to put together some responses for you, David, and to be very frank with you, we're going to have to send them to you hereafter, right? Because we just had to look through some stuff, and that's the risk when you take questions live. You may not always be able to flip through to get the responses. So David, we've noted both of these questions, and we're going to respond to you directly offline. Thank you very, very much. So I think that's it, because we're not seeing any other questions come in either, and so we will use this opportunity, therefore, to wrap another investor briefing. Again, we thank you for joining us, and we appreciate your continued partnership, not only as shareholders, but also as clients, and of course, as always, acknowledging the wider JMMB team who ensures that we continue to deliver on our awesome mandate. So thank you very much again for joining us, everyone. We appreciate your time and participation, and we look forward to seeing you next time. Now, I know when next we do this, it will be actually in 2024, God's willing, when we come back for our 9-month conversation. So please allow me to take this opportunity to wish you all a very peaceful, safe, abundant, and love-filled holiday season. And God's willing, we will see you in the new year. Thank you and goodbye.